The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Well, I think it's topping, and I think it's probably topped. The question, though, is when do you break the bridge underneath your feet and collapse, okay? And when you look at the price chart, again, the charts I sent you, the top chart is a simple weekly price chart of NASDAQ 100. And the reason we pick it, of course, is it's the leader index. It better than doubled what the S&P did since the 2009 bear low. Over the last 15 years, it's gone up far more than double. And we all know that most of the leader symbols that everybody likes to talk about and focus on, they're embedded in the front end of the NASDAQ 100 with very heavy weighting, such that you can basically take the NASDAQ 100 and take the last 95 stocks and throw them away, okay? And just look at the top 5 or so because of the weighting. Same is true with the S&P, but a little less emphasis on the weighting of those same symbols. But they're still front-end weighted indexes supposedly reflecting the U.S. stock market. And we know that's not really true because there are some sectors that are not doing as well as the S&P and NASDAQ and are extremely vulnerable, just like the S&P and NASDAQ. And for instance, the small caps basically double-topped recently at their 2021 late 2021 price highs. So the small caps only came back up to the prior peaks. But anyway, what I wanted to show is the two views of reality. And the one that's the most popular is, of course, the price chart. And it's, if you try to draw a multi-point uptrend going back to the 2022 price lows, that would be in October of 2022. So it's been 2 years plus, and try to draw a line that connects more than 2 lows, like 3 or 4 lows in a row, all lined up perfectly to draw a valid trend line. You can't do it. If you draw a line through those first 2 lows, it just goes off into space. You're nowhere near it. You more or less have an upward curvature. And so when you look at the price chart, you think, wow, it's fantastic. There's nothing here. I got to go a long way down to break anything, But when you look at our momentum charts, you see a totally different picture. Yeah, if you look at that top chart again, you'll see it's just upward curvature. And if you go back to that October 2022 low, just above 10,000, and try to draw a line that connects more than 2 lows, trend lines aren't valid unless they at least connect 3 lows, okay, to define a line, and you break it on the 4th effort. Any 2-point trend line is basically invalid, even on a price chart. But anyway, you don't have anything nearby you can break. The last major pivotal low you could see was last summer. In August, we dropped down under the 18,000 level on price and came up. So if you want to use that as your stop out point, well, you're going to give up 4,000 points from the high before you even acknowledge that, this market's in trouble. But now if you scroll down to the bottom chart, that shows what this shows is each week we plot the closing price of the NASDAQ 100 in its percent relationship to the 3-quarter moving average. Now that's a long-term moving average. The 200-day average shifts every single day, little micro shifts up or down. 3-quarter average, though, is about the same duration of time, but it only shifts once every quarter. It goes up, follows the market underneath, or if you're in a bear trend, it'll be above the market usually. In this case, you can see that it was since the 2022 low, we went from 26% below that average and shot up to a peak reading in 2023. It was about 29% over. And then we went into this, we dropped, and then we went into a more or less sideways range, while, of course, price continued to go higher. But when we plot it in relation to the 3-quarter average, each weekly close as a percent, how much percent above or below, we have the black line. When the black line connects 1, 2, 3, 4 pivotal lows, almost 5, and you'll see that the current reading, by the way, which is I did just before this report, where the NASDAQ was at that point in time, which is not the close yet, is hard down and right in front of that black line. Or as you drop another percent or so, you could blow that structure. Okay. And if that were a price chart, you'd say, oh, my goodness, I got to get out of here, But there's another line we've got here that's quite interesting. It's a little red horizontal line there. And it goes back to the beginning of last year. And there was a low in April, and there was a low in early August, and there's a low in late August. So all three of those pullback lows that define that red horizontal were 5.1 to 5.2% above the three-quarter average at that point in time. No, the price wasn't making the same horizontal low, but momentum was stopping exactly just above the plus 5% level. Never had a weekly close below that red line in the last year or so. If you close a week at 5% over the current three-quarter average, you will blow not only the black line, but you'll blow that red horizontal, which is almost perfect to the decimal. And that level is just barely below the low trade we've seen in the recent drop, down under 21,000, around 20,700 zone. We were very specific in our reports. So we're dancing above the structure. Do you feel lucky that this bridge that's been banged on for so long and created such clarity of structure, you think it's going to hold again? We don't. There's other metrics of similar time scale and lesser time scale that have already broken. And many of the subsectors within the stock market, when you run similar studies of them, they've already broken. So I think we're literally a rat's hair above the level that will blow the bottom out of this market. And whenever we find a structure that's so clear, the momentum structure, so many hits on it, the ripe, we call that ripe, okay? Whenever you see a structure that's that ripe, it's intended for use, not some future date down the road, but it's now so ripe it's ready for use. We suspect it will be used this quarter and quite probably in the next few weeks. Once you break it, we declare we're in a major bear trend. Well, we've had what we call, people like to talk about prior stock market bubbles. The 2007 high was a bubble, it was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932 and wiped the thing off the page almost, percent-wise. It took decades to get back to it. So those are things people call bubbles. But this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see, even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically. It's the most essential commodity, because when I buy from Mr. A to buy a product and he gets the money and I get the product, he wants to be sure that what I give him is actually going to hold value between now and next year, and so forth. And if it's changing in value because of the quantity of money increasing drastically, in the last 15 years, we've had more money growth than we've had in any other 15-year period, percent-wise, decay in the real value of the money. And then we've had artificially low rates. So that creates errors, individual micro errors, family errors, corporate errors, and they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busted. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, whoa, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens. by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000.com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. NASDAQ went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50% in S&P. They cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started. Once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here. And desperation and moves by central banks to buoy their assets they deem worth buoying, like the stock market. The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Because once that blood starts to come out of that market, it goes somewhere else. Anytime the stock market collapses, the asset flow doesn't disappear. It actually seeks other places. Usually that's T-bonds and gold. This time around, it's going to be primarily gold and related markets. And it's the breakage of the stock market that is the key pending impetus for gold.